As useful as the constant growth rate model is, quite frankly, not all stocks are constant growth rate stocks. Some stocks don't pay dividends at all, and we may expect them to pay dividends in the future. Some stocks may be going through a rapid growth phase where currently they're paying really high dividends and dividend growth is quite high, but we expect that to settle out in some long-term constant growth rate in the future. So we need a way of valuing non-constant growth rate or variable growth rate stocks. Fortunately, we can use our constant growth rate model and make some adjustments to them so that we can handle stocks that do not have a constant growth rate of dividends. To do so, we have to use a multi-step procedure. The first procedure is the first step in our procedure is to find the value of all those future cash dividends during this initial growth period, the period before we get into the long-term constant growth rate and dividends that we expect. The second step is to find the present value of those dividends during that initial non-constant growth period. The third step is to find the present value of the stock at the end of this non-constant or the initial growth period, which is simply our constant growth rate formula. In other words, the value of the dividends at period N, the first period N plus 1. This is our first period of the constant growth rate. This is the first dividend in the constant growth rate portion divided by R minus G. This is simply the factor to find its present value. Step 4, simply add the present value of the dividends during this initial or non-constant growth period and add to that the present value of the stock, and add to that the present value of all those dividends during the constant growth rate period, or the present value of the value of those, or the present value of the stock and the present value of the price of stock at the end of that initial variable growth period. So let's work through an example, because the example isn't nearly as scary as all those formulas are. The most recent annual dividend payment of Warren Industries was $1.50 per share. The firm's financial manager expects that these dividends will increase at a 10% annual rate over the next 3 years. Now that's their growth. The firm's financial manager expects that these dividends will increase at a 10% annual rate over the next 3 years. At the end of the 3 years, the firm's mature product line is expected to result in a slowing of the dividend growth rate to 5% per year for the foreseeable future. That's code for long-term constant growth rate. And the firm's required rate of return is 15%. So let's take a look at this in a spreadsheet. Alright, so Warren Industries, we have a required return of 15%. We have a variable dividend growth rate, that's that high growth rate period of 10%, and then our long-term constant growth rate of 5%, and our last dividend, D0, was $1.50. So in 2015, we had a dividend of $1.50. Now we're not going to count that, but we're going to use that as a starting point to calculate the future dividends, because again, the value of any asset is the present value of the future cash flow. So we don't want to include this $1.50 because it's already occurred. But we're going to use that to calculate D1, the dividend in 2016, D2, the dividend in 2017, D3, the dividend in 2018, and then we go to this from here over our constant growth rate. So in 2019, our dividend is only growing by 5%, so from $2 plus 5%, that gives us $2.10. So the valuation at the end of the variable growth period is simply going to be the present value of all those future long-term constant growth dividends, which we can use the constant growth formula to do that. So if we look at the cell, so we can see that the present value of all those future cash flows during our constant growth period is $20.96, which is G11, our dividend, 210, divided by C4, our required rate of return of 15%, less our long-term constant growth rate of 5%. That's where we get the 2096. So we now just simply have to find the present value. So in 2016 we have a total of $1.65. 2017 we have a dividend of $1.82. And in 2018 we had a dividend of $2 plus our $20.96, the present value of all those future cash flows during the constant period, for a total cash flow of $22.96. And then we calculate the present values of each one of those cash flows. So for example, 2016, that's simply the present value of $1.65 over 1 year, discounted at our required rate of return of 15%. We do that for each period, and adding up the sum of all those present values gives us a value of the Warren Company stock of $17.90, or we could just use the NPV formula, the net present value formula. You can see up in the upper left hand corner the cell formula. Use the NPV function in Excel, we also get $17.90. So for the variable growth procedure, we're just finding the present value of those cash flows during the variable growth period, and then when we get into the constant long-term growth period, we calculate the present value of those cash flows at the end of the variable growth period.